Hi there, Mike Brady with Generosity Wealth Management, a comprehensive, full-service wealth management firm headquartered right here in Boulder, Colorado. And I'm actually not in Boulder right now. That's why I'm a little bit more casual than usual. I usually have a library behind me, a blazer on. But for the 4th of July weekend, I thought I'd come up to our family cabin in Wyoming. And with high-speed satellite internet, cell phones and computers and scanners, and my entire office is right here as if I was right there in Boulder. Technology is wonderful. I hope you're enjoying the summer. I'm enjoying when I'm not working. The mornings and the evenings, the sunrise and sunsets are absolutely beautiful. I hope you're having a wonderful summer as well. So this is our second quarter review, sort of a year-to-date review, and a rest of the year preview, kind of a mid-year mid-report, okay? Kind of a halftime check-in here. We're going to talk about Greece, we're going to talk about China, interest rates, but first let's talk about what's going on so far right now with the big picture. Big picture is, so far this year, the unmanaged indexes are about break even. They haven't been really that volatile, although there have been some volatile days. But in general, it's actually, in comparison to historical terms, a relatively low volatility. I'm going to put up on the screen there the last 18 years of the unmanaged stock market index S&P 500. Why it started in 97, I have no idea, but the chart starts there. And you're going to see some big swings up and down and up and down. And since March of 2009, you're going to see that we've been on a very nice upward mobility on that particular index. The stuff that's happened in the last 6 months, the last 12 months, although it's taking a little bit of a breather, it's a little bit of a consolidation period. I mean, there's times when the market goes up, it goes down, and times when it goes sideways. And right now, we've been going a little bit on the sideways. I'm going to put another chart up there, and you're going to see, this is one of my favorite charts, and frankly, every video that I seem to do anymore, I put this chart up because I like it so much. But this is since 1980, so that's a good 35 years of the unmanaged stock market index, S&P 500. The numbers on the top of that x-axis are the end of the year return. So 27 out of 35 years have actually been positive. Some of them are negative, of course, but 27 out of 35 have been positive. But during the year, that's the number at the bottom, that bar chart underneath the x-axis, and that's the intra-year decline. That means that, just hypothetically, if the market went up 10% and then it lost 4%, down to 6%, and then went up and ended the year at 8%, rebounded back, that would have an intra-year decline of 4%, because from the top to the bottom throughout that year, there was the maximum 4% decline. Well, that's actually what we have so far this year. The S&P 500 is about break even as of June 30th, and it's really kind of been going up a couple percent, losing a couple percent, up a couple percent, lose a couple percent. And so that intra-year decline is relatively minor mild when you look at it in comparison to previous years of double-digit highs to lows. So that's been kind of the first 6 months of this year. One of the more difficult things to do as an investor is sometimes to do nothing. And so my video here today will sound an awful lot like some of my videos in the past over the last 3, 6, 12 months, because we've actually been on a little bit of a holding period now. And it's my analysis that that holding period is not leading to a big, crevice that we're going to fall into and Armageddon before us, but one that will actually creep higher than it is lower. Our earnings per share are, for the market in general, are coming in positive. And, I continue to think this is a good market to invest in, and particularly in a well-diversified portfolio. I'm going to throw a chart up there. And what you're going to see here is this is another one of my charts that I use time and time again, but it's rolling returns. That first grouping is 1 year, the second grouping is 5, the third grouping is 10, and the last one is 20. And that's a rolling return going all the way back to 1950. And that third bar in each one of those groupings is a mixture of 50% unmanaged stock market index with 50% of an unmanaged bond index kind of shoved together. And what you can see is that time is our friend. I mean, historically, going back 65 years, if you had those two indexes mixed together, held like that, there's actually never been a 5-year time frame when you haven't at least made a little bit each on average each year. Some years might be negative, negative, and then you made up for it in the fourth year, the fifth year, etc. But when you average it out, if you hold it for that time frame, there's actually been never been a time frame, a rolling 5-year holding period where you've lost money. And the same thing with 10-year and 20 years. So we've got to be in this for the long term, I think, as investors. And so volatility in the market is a part of the game, even though we hate it every time that it happens. And I think that this is one of those times where the headlines are a little bit bigger than what we're seeing right now. One thing that you're going to hear an awful lot about in the next 3 months is interest rates. In September, the Federal Reserve is going to get together, and it is highly expected that they will start to increase the interest rate. And you're going to hear all kinds of Armageddon stories about it. And all I can say is that we've been anticipating this for a very long time, and I believe that it's priced into the market. When we look at the last 3 interest rate increases, which was 94 and 95, 99 and 2000, and then 2004 to 2006, initially there might have been a decline. I put that a graph up on the screen. Might have been a decline, but while the interest rates were increasing, the unmanaged stock market indexes continued to rise. And so it wasn't this huge, horrible thing that you might have been led to believe in the last 2-3 years while we're looking at historical. Now, of course, future, this time it could be different. Maybe the interest rates increase and the market goes on the downside. I don't think so. It's possible. But the last 3 rate increases, that hasn't happened. I mean, the market has continued to increase over a 2-year time frame, even while the interest rates were increasing. So there's not a perfect correlation that when interest rates increase, then the stock market decreases. That's just not true, even though you might have been led to believe that by some kind of watching something on TV. Something that's really big in the news right now is Greece. If I had to explain Greece, I feel for all the Greek people. They're in a world of hurt, and I'm not exactly sure where this is going, but it's relatively small. They have an economy about the size of Detroit. They have an area physically, geographically, the size of Louisiana. They're really, really small, but they are part of the European Monetary Union. And so therefore, the question is, how is that exit what's the moral hazard if they get bailed out? Now, I'm recording this on a Tuesday. They've already had the vote on Sunday, and they've rejected by a pretty substantial amount, 61%, of negotiating and taking the first deal. Well, not really the first, but the most recent deal that the European Union was giving them. So it's, I feel for the Greek people. I have to tell you that it's a little bit like having that family member who always has a big story about why they need money, but no matter what they do, whether it's a sibling or a child or a cousin, but they always spend more than what they bring in for whatever reason, and their habits don't change, their behavior doesn't change. So after a certain point, you stop loaning them money. You stop giving them money. Everybody in the family knows, don't give Uncle Joe this money or don't give Susie that. And so it's a little bit like kind of that ugly sibling in the European Union right now, which is Greece. And there's a few others that are looking to see what happens, Spain and Portugal, etc. And I don't want to minimize this in any way because it could be a bigger deal than it is, although I don't believe it is at this point, but it could. But when we look at history, sometimes there were small events that turned out to be big events. I mean, when Ferdinand was assassinated in 1914, it led to World War I. Well, it wasn't that small event of the assassination. It was all the alliances and all the, there was a bigger picture than just that one small event. And so this could turn out to be the same thing, although I don't believe that's going to be the case at this point right now. I think a bigger deal is China. I mean, you've been hearing me for years now talk about China and how I don't necessarily trust all of their numbers. Well, their stock market, which has just been on an absolute tear this year, just lost 30% of its value in the last three weeks. And so I think that those who are invested, that bubble there, are also realizing that what is reported does not necessarily always is not always the full information, and so therefore it might have been priced in inappropriately before, and now it's being corrected. And so if that's showing a slowdown in the Chinese economy, that's a huge economy. That's something that could affect all of us. So I think that that's something that we ought to watch as closely, if not more closely, than Greece, even though Greece is a spectacular problem at this point right now. That's what I've got. I am still optimistic going forward for the rest of the year, and so I'm not making any major changes. We're kind of in this kind of holding period right now. There's nothing that I'm seeing that leads me to change my belief from the last quarter, or even frankly the last year and a half, that having a well balanced portfolio makes sense, and that we're not going to have. I don't believe that we're going to have this huge decline, and so. I think we ought to just kind of stay with where we are right now without any major panic. So anyway, Mike Brady, Generosity Wealth Management, 303-747-6455. You have a great day. Give me a call. Give me an email. I'm always here. Thanks. Bye-bye.